Financial. We're the place you come to forge a stronger portfolio and to cut right through the market's weakness. Today, we're putting Regions Financial on the anvil. They just dropped their Q4 2025 earnings report, and believe me, the market is reacting. So our job today is simple. Stress test this report, hammer out the facts, and see if this bank is truly ironclad or if it's just thin plate armor. Let's get to it.
So, the central question we're tackling today is pretty straightforward. Is Regions Financial a fortress for your capital? Is it a bedrock that you can actually build on for the long term? Or are we just looking at a nicely polished facade with some serious cracks starting to form in the foundation? And that's really the key, isn't it? Any management is always going to tell you the walls are thick and the gates are strong. That's their job. Our job is to play the part of the siege engine, to really push on those walls and see what gives. We are here to find the truth that's hiding behind the headline.
All right, here's our plan of attack for today. First, we're going to build the balance sheet from the ground up, looking at those pillars of strength that the company wants you to see. Then, we'll bring out the magnifying glass and start checking for cracks. We're going to go deep into the loan book, and we're going to scrutinize those expense lines. After that, we'll examine their blueprint for 2026 to see if their plan actually holds up under pressure. And then finally, we deliver our final verdict. Okay, let's get to work. Look, every solid analysis has to start with the foundation. You just can't skip it. We have to look at the headline numbers, the big, flashy metrics that management is putting front and center. This is their opening argument for why they think this bank is a rock-solid investment. We absolutely have to give this its due diligence before we even think about bringing out the sledgehammers. So, let's see what they've built.
Okay, let's really break this down, because the entire bull case for this company, it really starts right here. For the full year, just focus on that second column for a second. We're seeing over $2 billion in adjusted net income. Revenue is sitting north of $7.5 billion. These aren't just numbers on a spreadsheet. These are heavy-duty industrial strength figures. They prove that even in a really tough competitive environment, this bank is a cash-generating machine. Now zoom in on that bottom line. The full-year efficiency ratio is 56.8%. For a little context here, in the banking world, anything under 60% is considered pretty good, and getting down close to 50% is excellent. So coming in under 57%, well, that shows Regions is running with superior operational discipline compared to a lot of their peers. They are, without a doubt, running a very tight ship. Okay, I'll give you that. Big numbers are hard to argue with, and you're right, that efficiency ratio is solid. But a big ship can still spring leaks, right? These are just the high-level stats. This is the view from 30,000 feet. What really matters is what's happening down below, in the engine room.
And this right here, this is the engine room. 18.51%. That's the adjusted return on average tangible common equity, or ROATCE. Let's be crystal clear about what this means. That is a best-in-class, top quartile performance. Seriously, this isn't just good, it's elite. What this number tells you, what it screams at you, is that for every single dollar of tangible equity that shareholders have in this business, the company is generating over 18 cents in profit. It's a pure, unadulterated measure of profitability and capital efficiency. And let me tell you, in a higher interest rate world where capital isn't cheap anymore, this metric, this is everything. It shows that management is deploying its capital incredibly effectively to generate maximum profit. This is the engine of shareholder value. It is powerful, it's efficient, and it's what separates the real workhorses from the show ponies in this industry.
Okay, hold on. This is exactly what I'm talking about. We've just seen these really strong profitability metrics, and boom, here comes the CEO to tie it all up in a neat little bow. Of course he's going to come out and say the foundation is strong and that they're building momentum into the new year. That's his job. But let's look at the words. Solid growth? We need to verify that. Strengthening our foundation? Show me the proof. This is the story, the narrative. Our job now is to separate that beautiful narrative from the cold, hard reality of the numbers that are hiding underneath the surface. So is this confidence, or is it just hype?
So let's do exactly that. It's time to check for cracks. The foundation, yeah, it looks pretty solid on paper, I'll admit. But now we apply the pressure. We are going to put that solid growth claim to the test by looking at the absolute core of any bank, its loan book. And then we're going to comb through the expense side of the ledger to see if that whole tight ship story really holds water. Come on, if there's a weakness to be found, it's going to be in one of these two places.
Now this is where it gets really interesting, because what you're looking at here is a flat-out contradiction. On the left, you see the chart of average loans. It's not going up, it's actually ticking down from $96.6 billion to $95.7 billion in just one quarter. Then you look to the right and you have the company's own admission straight from the earnings call. Loan growth was challenged. So how do we square a shrinking loan book with a narrative of solid growth? It just doesn't add up.
That's a fair challenge, a totally fair challenge, but there's critical context here that you can't ignore. In that very same call, they explained exactly what happened. Their large corporate clients, we're talking the big fish, they took advantage of favorable capital markets and paid down their bank debt. So this isn't necessarily a sign of weak demand from their core everyday customers. It's a sign of a shifting financing environment. They also said they intentionally got out of certain mortgage portfolios that weren't relationship-based, basically to de-risk the balance sheet. So you could argue it's disciplined portfolio management, not a collapse in their core business.
Okay, I hear the explanation, I do, but even if it's disciplined portfolio management, a shrinking loan book is still a headwind for future growth, isn't it? Fewer loans means less interest income down the line. That's just math. You can call it discipline, but it's still a drag on the top line.
Okay, so before we get to the next big number, we need to take a second and define a really critical term for anyone who's trying to stress test a bank: net charge-offs, or NCOs. You can think of this as the amount of debt the bank has essentially given up on ever collecting. It's gone. It is a direct measure of the quality of their loans. The higher this number, the more cracks you have in your credit portfolio. And make no mistake, it's a direct hit to the bottom line, to earnings. So let's see what that number looks like for Regions. 0.59%. Now, is this number zero? Of course not. But in the grand scheme of banking, this is a very manageable level of loss. It's not a red flag. It's not a flashing red light on the dashboard. It shows that despite the challenging environment out there, their underwriting discipline is holding up pretty well. They are not seeing some massive wave of defaults crashing over them. Manageable for now is what I hear, but it's up from 0.53% for the full year. It's the trend that has me worried. Is this the leading edge of deteriorating credit quality? Are we just starting to see the first signs that the loans they made back when money was easy are starting to sour? Look, this number isn't a crisis today, but it is absolutely a warning shot. And if we see any kind of real recession in the next year, that trend could accelerate fast. A small crack can become a chasm when the ground starts to shake.
Okay, let's flip over to the other side of the ledger, expenses. The headline here really is discipline. Adjusted expenses were basically flat quarter over quarter. Salaries and benefits actually went down, and they got a huge 80% break on their FDIC assessments. This all supports that tight ship argument we saw earlier with the strong efficiency ratio.
A tight ship with some very expensive new equipment being loaded on board. You can't just gloss over the but and the and on this slide. Equipment and software costs are up 4% for the year. But more importantly, they are explicitly telling us that their technology spend is permanently moving higher, from a range of 9 to 11% of revenue up to 10 to 12%. That's a structural increase in their cost base. And let's be real, this isn't just a regions problem, it's an industry-wide arms race. Every bank is being forced to pour billions into digitization just to keep up. So is this an investment that's going to pay off with amazing efficiency down the road? Or is it a permanent drag on their profitability that they're going to be fighting for years and years to come?
All right, so we've examined the present. We've seen the clear strength in profitability, and we've identified the potential cracks in loan growth and expenses. Now it's time to look to the future. This section is all about their 2026 blueprint. We are going to analyze the company's own guidance, what they themselves expect to happen, and then we'll look at the external headwinds that could blow their plans completely off course. This is where the rubber really meets the road. So, here it is, the guidance, straight from management's mouth. At least they're being transparent. They see a near-term dip in net interest income, a slow start to the year for their capital markets business. And yeah, expenses are ticking up. But the crucial point here is that last one. They still expect to generate full-year positive operating leverage. Let's just define that really quick. It means they expect their revenue to grow faster than their expenses for the full year, which would actually expand their profit margin. That right there is the key promise they are making to investors for 2026.
Right, but that's a promise for the full year. What I see right now is a weak start. Net interest income is declining, capital markets are weak, expenses are rising. It looks to me like they're guiding for a really tough first half and just praying for some kind of big recovery in the back half. A lot can go wrong between now and then.
That's true, but you have to admit, a lot of companies are guiding conservatively for the first half of the year given how uncertain the economy is. Setting a low bar early in the year can be a very prudent strategy. The key, as you said, is whether they can actually deliver on that full-year promise. And this slide just illustrates the point perfectly. Forget the promises for a second and just look at the market's cold, hard verdict. As you can see right on this chart, the stock just takes a nosedive right after they release the earnings. Why? Simple. They missed earnings expectations. a negative 6.56% surprise. Wall Street did the math on that weak guidance and those rising costs, and they hit the sell button, hard. The big question is, does the market see a crack that management isn't fully admitting to? The price action is telling a story of serious skepticism.
But here's the CFO providing the rationale for that weakness. He's saying the softness in capital markets, which is a key fee-generating business for them, was just a matter of timing. It wasn't a collapse in the business itself. Deals that were supposed to close in Q4 got pushed into the new year. So he's essentially telling the market, hey, don't panic, the business is still there, it's just been delayed a bit.
Well, that's one interpretation. The other interpretation is that in a tougher economic environment, deals are just plain harder to close. Maybe the M&A pipeline is getting clogged up. This could be a sign of a broader slowdown in the whole M&A world, which, is often a canary in the coal mine for the wider economy. So is this really a temporary timing issue just for regions, or is it a warning sign for the entire market? Come on, the "it's in the pipeline" excuse is one of the oldest in the book.
And we absolutely have to acknowledge the external factors. This is not happening in a vacuum. These are the risks that the company themselves list in their own filings. Geopolitical instability, regulatory changes, these are major fault lines that can shake any company. And for regions specifically, I'd point to two key risks on this slide. First, capital requirements. For any bank, this is a constant pressure point. Regulators can just change the rules of the game at any time, forcing them to hold more capital, which in turn reduces their profitability. Second, look at their geographic concentration in the southeastern U.S. That makes them particularly vulnerable to the economic impact of major natural disasters, like hurricanes, which, let's face it, seem to be increasing in frequency and severity. So the crucial point is, even if management executes perfectly, they're still navigating a very, very unpredictable landscape.
Okay, we've laid out the foundation. We've hammered on the weak points. We've looked at the blueprint for the future. Now it's time for the final verdict. We're going to weigh all the evidence, the bull case versus the bear case, and determine if this company is truly a fortress or if it's just a fragile facade.
All right, the bull case is clear, and it's built on that powerhouse 18.5% return on equity. That is undeniable, best-in-class strength. They're also seeing record fee income in areas like wealth management, which proves they can generate revenue outside of just making loans. Their expenses are generally under control, their capital position is strong, and the CEO sounds very confident. This is the argument for a fortress that is built to last. And the bear case is just as compelling, if not more so. That so-called fortress has a moat that's shrinking with that challenged loan growth. It just got hit with a big rock in the form of a negative EPS surprise that really shook the market. And the cost to maintain the castle walls is going up structurally with those rising tech costs, and their forward-looking guidance is cloudy and weak, at least for the near term. The market itself is skeptical, and that's reflected right there in the stock price. This is the argument that what we're really seeing is a very well-polished but potentially hollow facade.
So that's our stress test. We've laid out all the evidence for you. On the one hand, you have a highly profitable, well-managed bank that's navigating a tough environment with a lot of discipline. That ROATCE number is elite. You just cannot ignore that. On the other hand, you have tangible signs of slowing growth, rising structural costs, and a market that is clearly worried about the next 6 months. The final verdict really comes down to what you believe. Do you trust the best-in-class profitability and management's long-term plan to navigate these headwinds? Or do you heed the warning signs from the shrinking loan book, the weak guidance, and that very negative market reaction? We've given you the tools. We've shown you the pressure points. The final question is one you have to answer for your own portfolio. Is Regions Financial truly ironclad?
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.